Hi, I'm Jim Jackson, and I am bonding over bonds with Kevin Kaase. Kevin, pretty exciting last couple of weeks in fixed income, don't you think?
Definitely has. I mean, it's been a wild ride in the treasury market for sure.
It has. After the Fed meeting last week, the 10-year rates initially went up only to fall, and are pretty close to their second quarter lows right now.
I agree.
So, what's your view on the Fed meeting last week?
So one of the most discussed developments that has come out of the meeting is the changing of the dot plots. The dot plot shows when members of the FOMC expect to raise rates, if you will. The latest dot plot shows a majority of the members are expecting interest rates to rise in 2023, which is clearly sooner than expected. So it looks like most of the economic data, such as GDP or CPI numbers, that data is moving closer to the Fed's targets. However, 2023 is still, 2.5 years out there.
Yes, Kevin. I mean, the one thing I think we know for sure is that both the market and the Fed cannot predict what the economic environment is going to be like 2 years out. So we think it's best to look at a range of metrics, right? So the biggest topic right now is inflation. Is there a metric that you look at?
Well, one that we never really talk about or haven't talked about on this program is the U.S. dollar. I mean, that has definitely been strengthening. What that means is that deflation imported into the U.S. So that further bolsters the argument that inflation is transitory.
Sure. And Kevin, the one thing that I like to look at is the 5-year break-even rate, which peaked in mid-May, has been falling pretty much ever since. So the market tends to think that the Fed has a handle on this. Now, we're also seeing moves in the Treasury market.
Definitely. One thing I do want to emphasize is how difficult it is to actually predict interest rates. Market pundits have been out there saying that rates are going to rise, and in fact, we've seen rates go down.
Yes, and I think what it shows is that when managing fixed income, if you're going to predict rates to drive your returns, your outcome is going to be binary. Either you get the rate call right or you don't. We think a better way to approach it is by focusing on generating income and not guessing where rates are going to go. So thanks, Kevin, and thank you as we bond over bonds.